Hey, folks, welcome back from to Money and Politics. It's November 30th, and I hope it's the first time I've talked to you since the Thanksgiving break, and it's kind of weird to try to get, on one hand, back into the swing of things. And what a day to come to you, because it has been an ugly market, as I'm sure you all know. The Dow dropped 653 points, which was about 1.86%. The Nasdaq was down 1.5%. The S&P down 1.9%, almost 2%. So not a good day in the market. With that in mind, I'm kind of surprised, and we'll talk a little bit as we do about Humble. I'm a little surprised that even Humble, well, it says down 10%, but it's down to about where it was a week ago, and on heavy volume, 9.5 million. I'm rounding up. 9.5 million shares. You can see there the 6-month chart, but if we go to the 1-month chart, you can see, or 1-day chart rather, this is today's chart, and so we had a bit of a rebound and a sell-off near the end. So obviously it's not a good day anywhere for looking at the stock market. Everything, I don't think I had one thing in my portfolio, which I don't have open right now, was up today. One thing I would say, and I think I've shared this in the past, actually before I do that, let me just recount. There's a variety of things in general about the market going on right now. And that is, look, we have to some extent, I don't know to what extent this is an issue or not, but typically at this time of year, you're getting some tax selling going off. If someone has a gain of $10,000 on a stock that they sold, so as to not have to pay the capital gain tax on that, they can sell something where they have a $10,000 loss. And so the loss outweighs the gain. Now, if we look, as an example, at Humble, and I would guess all of us are down right now on Humble, given where it's been for the year. Some people might be selling now $10,000 worth to offset the gain so that they don't have to pay tax on that $10,000 gain. And if after 30 days they want to, they could go back in and buy the shares they sold 30 days from now, or after 31 days from now. And, they get around the wash sale rule, but yet can at least take some of the, use the sale of stocks to offset their loss. So you got the tax sale thing going on. You've got the rising interest rates, which we'll come to in a minute, and you've got the COVID. Every other day or every other week, we have a new variant coming out. So, it's at what point do you stop hearing that? Today, I was covering the comments of Federal Reserve Chair Jerome Powell, as well as the Treasury Secretary. They were both testifying in the Senate today before the U.S. Senate Banking Committee. And basically, what came out of that is that Jerome Powell was saying that he was going to, the Federal Reserve, not just him, but the Federal Reserve was going to be looking to quit pumping all the liquidity, all the bond purchases that they've been doing, which have been keeping interest rates low. Let's listen, first of all, to what he said.
We now look at an economy that's very strong and inflationary pressures that are high, and that means it's appropriate, I think, for us to discuss at our next meeting, which is in a couple of weeks, whether it will be appropriate to wrap up our purchases a few months earlier, as I mentioned.
All right.
But in those 2 weeks, we're going to get more data, and we're going to learn more about the new variant.
So I didn't talk last Friday. It was the day after Thanksgiving. That's when the market also sold off a lot because that's when we had the latest variant come out. And my thought was this is a gross overreaction. And the Fed chairman said, "Look, we have a strong economy." And folks, we have some real problems, but I want to put this somewhat in the context. When you spend the kind of money that the federal government has been spending, when you pump that much money into the economy, and you have it coming in two ways. You have it coming both by the Fed, which is monetary policy, and you have it coming from fiscal policy with the administration looking to spend all of this money. They already spent over $1 trillion. I think it was 1.7 trillion earlier in the year. Now they're trying to do another big deal, which I suspect is not going to pass in the Senate. But when you're pumping the kind of money that we've pumped into the economy, frankly, over the last year and a half, as we counter the downturn of COVID, you better have a good economy. I mean, we're awash with cash. The danger is going to be that we are diluting the dollar, and that gets into one thing after another. That's part of the reason why people are going into the cryptocurrencies. They're looking at things like Bitcoin and the others as a way to hold on to their purchasing power because they fear the American dollar is going to be devalued. Now, when we get into these moments, people typically have not had any kind of a sense of history in general. But I would say, look at what we have faced over the last 50 years from 1970, this chart from 1970 to the year 2000. And in there, you're going to see, and I've shown this to you before, a number of downturns, as you see, of significance. But they don't last. And those are the times typically when the market goes down that you want to be purchasing. I wish there was a way I could reach out and point at this stuff. But you have, if you look just to the right, down at the bottom there, if you look just to the right, about halfway through between 1985 and 1990, there's a little dip there. You almost don't notice it. And that was the huge sell-off of 1987 when the market fell 500 points in one day, and that's when falling 500 points in one day was a big deal. Today we fell 653 points. And it's, what did I say? It's on the Dow, 1.8%. That was something like, I forget the percentage, but it was something like a 20% drop in one day. And that's that little blip. Then we go up and we had the market popped at 2000 and that came crashing down. Plus along the way we had, going into Afghanistan, going into Iraq. And then we come back up. And just as we got back up to the same point, we come crashing down from the real estate crash. So the long and short of it is, this is why, how many times have I said, talking to you about humble, but it's not just about humble. I bring to you the view that you have to be, in general, a long-term investor because there are going to be downturns along the way, whether it is in humble or whether it is in just the market in general. And some of these downturns are going to be significant and long-term, and others are going to be of a minor consequence. The biggest downturn, which was really bad, was the NASDAQ, when we did have a bubble, and back in the year 2000, March of 2000, the NASDAQ got up to 5,000, and then it fell, and we didn't get back up to 5,000 on the NASDAQ until 2015. So that was a 15-year wait to get back to where you had been in March of 2000. Now, that said, what do you do in the meantime? If you were buying the NASDAQ after it fell, and it fell something like 85% between March of 2000 and December of 2001, both in terms because it was overvalued and got ahead of itself, and then because we had the attacks of 9/11 and then going into Afghanistan and the war and all. So the market was severely depressed, and that brought up a lot of bad stuff and drove the market down, and we all had to wait for it to come back up. Let me show you something while it's on my mind. Speaking of where I am, I was going to do this later. You know, I have talked many times about T, as in Thomas, TQQQ, which is 3 times the NASDAQ, and that is now at $163 and about 50 cents, down 4.3% today. Okay, down 4.3%. The NASDAQ by itself was down 1.5. So the TQQ goes up 3 times faster than the NASDAQ, but it also goes down 3 times faster. One of the things that has been one of the worst things you could have bought over the last 10 years is the opposite of the TQQ, and that is the S, as in Sam, SQQQ. The SQQ is the ultra short. Instead of the ultra long, it's the ultra short on the NASDAQ. And this is a one-day chart, but if you look at this over 5 years, that's what happens when you're shorting the NASDAQ and NASDAQ goes up in value. You lose your shirt. The reason I say that is this is now down, as you can see, to $6.31. If you think at some point that we are going to go on a prolonged sell-off, the SQQQ, which I don't think I've ever mentioned to you before, is a way of hedging your portfolio so that you could buy, let's say right now, you wanted to buy some of the SQQQ, 100 shares, that would be $631. If the NASDAQ were to fall precipitously in value, this would go up because this is a short on the NASDAQ. So it is a way, you've heard of hedging your bets, you've heard of hedge funds. This is a way of becoming a hedge manager of your own portfolio and to put in some insurance on your portfolio by buying some of this. Would I recommend you do that? When you buy the SQQQ, you almost would want to hope that you are wasting money. Not almost. You would want to hope that you are wasting money when you buy it. Because this is like buying home insurance. You don't want to be making money on home insurance because that means your home has either been blown away or burnt down. And this is kind of like home insurance on your portfolio, at least if you're invested in the NASDAQ. So if you had the TQQ and you said, hey, Terry, we were at relatively all-time highs until recently, would you recommend, what could I do? Should I sell the TQQ? This is where you could maybe buy some of the SQQ. My major point here, without getting too complicated, is that I want you to be aware that there are shorts on ETFs that are shorts on the overall market, whether the S&P or the NASDAQ, and you can use these carefully as hedges. Now, where I would buy the TQQ long for and hold on to it for a long time, I would not buy the SQQ and hold on to it for the long time. And when I say the SQQQ, because you can see here over a 5-year chart. Let's go full screen here for a minute. This chart's, and here we go too. Am I on the 5-year chart? Okay, so I wonder if I can change this color, make it a little more viable. So we're going to make the SQQQ red. Let me pull myself out of here. And I want to compare this to the TQQQ. So these are polar opposites. One is a 3 times long. This is the 3-time long on the TQQ is 3-time long on the NASDAQ, the SQQ 3 times short. Boom. Look at the difference there, folks. So the SQQ went up so much more by comparison to the SQQ going down, that you don't even notice the SQQ. I mean, it is just like a flat line. But this is where, and look along the way, this is a 5-year chart on the TQQQ, which is the green. Look how many times, here we had a split, and that was September of 2019. And then we had a split again. This was, I think, January, isn't it? January of, or is that August of 2020, I guess it is. So in the meantime, you also had 2 splits. So the TQQ is up 1,500%, and the SQQ is down. So you would not, the lesson here is, you would not have wanted to hold the SQQQ long term, okay? Let's go to, this past year has not been the greatest for the TQQ. It is up, but it's not up as much. So here you can see how the two are polar opposites, the exact opposites. So that when you see this almost circle here, when the NASDAQ went up, and this was in April, you can see correspondingly how the SQQQ went down. When the NASDAQ fell, and here we're at May 12, you can see how the SQQ then came up. So again, I just want you to be aware that there's the SQQ. When you are when you are near all-time highs, if you wanted to buy a certain percent of the SQQ in case there was a market downturn, you could do that, not to hold on to it, in my estimation, long term, but you could do it short term, and then if you had a market sell-off, I would get out of the SQQ. So again, follow the news. Now, as I said earlier, when we are dumping as much money into the overall economy as we are, then I would think that the market is going to continue to be going up for some time. I think that what we are seeing in this sell-off, because of the Federal Reserve, that I already played the clip for you, announcing that they were going to be cutting back on buying the bonds, which basically what this means is that interest rates are going to go up. Interest rates going up are bad as a general rule because the price of money is higher for corporations. So that's generally bad for them. But look, folks, we have to do this because otherwise we're going to have runaway inflation, and that's also bad for everybody, or for most people. Interest rates are going to go up some. I don't expect them to go up precipitously, and if we don't respond to the inflationary pressures, inflation over the last recent times is up by some measurements as much as 8%. That's way out of line. The Fed target was 2% on inflation, and I think they're kind of screwing things up. Hopefully they don't wait too long to raise the interest rates. So what might we see? We might see interest rates going up to 4 or 5%. What's that going to mean for the market? It means going forward, we're going to have a bit of a sluggish market. And at some point, which is why I wanted to bring up the SQQQ, at some point we are going to have a market that is going to have a downturn. And again, when we go back over the last 50 years, we had a number of times where we had some sharp downturns. When we look at the last 12 years or so, when you look at that last major sell-off, and it looks like it's right at about the beginning of 2010 there, right down there if you look, right at the beginning of 2010, from there we have been up on a bull market for almost the entire time until just recently when we had a bit of a sell-off, and that was due to COVID. So, folks, one of the things I tell everyone, no one has a crystal ball as far as where the market's going to go. We can look at things and we try to have some predictions. Jerome Powell today, the head of the Federal Reserve, said that they missed raising interest rates because they thought the economy, they thought productivity was going to be stronger than it was. They didn't anticipate the shortage of the chips that are holding back the production of cars and other things. They didn't anticipate a number of other supply chain problems. So this is all having a bit of a drag on the economic activity of the United States. And that's why the Fed, looking into their crystal ball, blew it because they should have raised rates earlier. And so he was doing a bit of a mea culpa. That's why the market was down. I think I think I said it before, it would go down, but I think that's going to be short-lived. And why do I think it's going to be short-lived? Because everyone knows interest rates need to go up. They've been artificially low for the better part of a decade. The normal range of interest rates is somewhere from about 4% to 8%, and we've been operating at about 2%. So that's not sustainable. Okay, one last thing, and I meant to bring this up earlier. So we had the release, I think it was just yesterday, it seems like a week ago, of this thing on Humble with the S1 form, and they go in, and this is like 500 pages. I can put a link to this if you want. This is kind of part of the good news is that Humble is to be going to the higher level of ratings within the OTC. This is part of the process ultimately to go to the NASDAQ. And so that's a good thing. There are all kinds of legalese here. This is a legal document with the Securities and Exchange Commission. Here's whoops, I meant to stop there. Anyway. And you can go through and look at this. One of the areas that it brings up is if I can get it to stop here, is the area of dilution. So you click on that. Let's see if I can read it over here. On dilution, it's about 3 paragraphs. I'm not going to read it all, but it says the first paragraph, the sale of shares of our common stock. Let me start again. The sale of shares of our common stock by the selling shareholders may have a dilutive impact on our stockholders. Now, some of the critics of Humble go, see, I told you so. You said it wouldn't be diluted. It is. When I have talked about the B shareholders are not going to just dump all of their shares at one time come December. That's what I was talking about. I still think that's true. They're not going to take all of these shares and immediately sell them, which would be like getting hit by a tsunami wave. Okay? That's kind of what the critics were trying to say was going to happen. I'm saying that's not going to happen. To the extent that they are moving some Humble in this document, they're moving some of these things that were warrants and they're moving them to common stock so that they can have these transactions. George Sharp is doing some of that. He has, if I counted right, about 67 million shares that he would have in common stock. I don't know if I can find it right now. Forwardly, here, 62 and a half. So Forwardly by itself, the corporation, George Sharp by himself, as I recall, is 5 million shares, but Forwardly, I don't see it, but Forwardly is 62.5. So those are the number of shares of common stock beneficially owned prior to the offering. Maximum number of shares of common stock to be sold pursuant to this prospectus for Forwardly 62.5 million. There are others. I just picked that. That's just one. So the way I'm reading this is that not that these all would be necessarily sold, but that they could be sold. I still think, especially now, we're back to 42 cents, that why would you, if you think Humble is going to go to $1, back to $1 at some point, and it was, at $1, when was it, back in the early part of September, so not that long ago. It was at about $1.50 back in June. Why would you want to sell millions of shares at 42 cents when if you waited, even if it came up, let's say out of 62 million you were going to sell 10 million. Why would you want to sell 10 million shares now and get $4 million, where if you waited until it went back just to $1, it would be worth $10 million? That's a $6 million difference. I think $6 million is worth waiting until the share price comes up. And I'm not even saying that they're going to sell at $1. I'm saying that if you folks want to read this document, it's 500 pages. Knock yourself out. This also gives you an idea of how much work Brian Foote has to go through when he is doing his job as the chief executive officer, and there's a lot involved in doing that. And on the other hand, when we look at what Brian is doing and has been doing just over the last week while we've been eating turkey, Brian has been out and about, and as we speak right now, Brian is working, the hardest working man in America. And sometimes that's because he's not in America. And where is he? Well, here he is today down in Santiago, Chile, working, as he tweeted, on getting a jump on Humble, working with Aria, and getting a jump on the South American market. So, look, folks, I'll close out with this. I haven't talking long today because I hadn't talked for a while, and there's so many different aspects of the story with the rising interest rates, with the COVID variant, which comes out every other week, with the S1 form that I'm kind of skipping around, I know, but I wanted to cover a number of things. What I would say we want to be, as I've said before, measuring Humble by, is what are they doing? And are they doing things? Because we can't be going by the revenues right now. We will be going by the revenues as they establish those, and we've talked about that before. But here's the Humble page on Yahoo Finance. And so you go down, and what do we got? Well, we just saw that Brian Foote is down in Santiago, so he's doing that. A week ago today, Humble announces the launch of Humble Pay mobile wallet with peer-to-peer functionalities. Just go past the ad, and we have George Sharp returns to Humble as capital markets advisor. We're probably going to be uplisted on seat the OTC, as George thought maybe by the end of the month. Well, this is the end of the month, but I think we can anticipate that that's probably going to be happening in the near term. We have, let's see, when was that? 2 months ago, Humble and Blocks announced strategic collaboration on blockchain incentives. And by the way, I meant to mention that Calvin Waite will be speaking on Twitter Spaces tomorrow night about that very topic. And then, Humble announces the launch of that was in September, the Humble Tickets platform and the NFT gallery. So, look, it's not my opinion. I'm just pointing out the facts here, folks. You have Humble just since this quarter, September, October, November. This is the end of the third quarter today. And in the third quarter, look at what they're working on and what they're doing. That's not to say that any app is finished, but they are out there doing things and creating value in the company. Revenues will follow that, and that means, I think, as always is the case, that as your revenues go up, then your profits go up, and that drives the stock price up. To the extent that, let me say this too. I got a note from someone who's long Humble, but he also shared that he was down 7 figures. Okay, so that's over $1 million. So when I talk about Humble and reason to be hanging in there, I'm not saying that that's not pumping the stock. I just reported the facts. I brought up statistics. I brought up government documents. I've talked about what's happening. I'm reporting what's developing. We see Brian down in Santiago, Chile. You know, as investors, that there are no sure things in life. But my point is, I know probably every Humble shareholder is underwater right now. And I don't mean to minimize that. I'm underwater and I wish I weren't. And I know that there's a lot of pain. And I didn't put as much in as the friend I just mentioned here, who's got over $1 million underwater. I understand that all of us are hurting by the share price being down. So I don't minimize that. I don't mock that. I'm there with you. But I am here to try to say, in the same way that I cover factual things, which is why I had recorded the comments of Jerome Powell earlier today, the same way that I cover politics of what's happening, I'm covering the Humble story. And I brought other things to you. And the other things, not today, everything was down. But the other things have been going up. But the other things I brought to you, like the TQQ, like InMode was way down today. But these things over the last part of this year have all been way up. I'm bringing my experience both as an investor and as a reporter. Part of what I'm sharing with you is my gut feel from having been through this, through the better part of these 50 years. I wasn't investing for 50 years. I'm trying to get my mouse, I don't know, it's not cooperating here. Look, as I said, there's a lot of ups and downs here over the last 50 years. And the investing game, in the most simplest way of saying it, the investing game is you're buying the future value of an asset, and you're buying it today. You're buying today the future value of an asset. We think, when we buy, that like the S&P chart, that the future value will be up, will be higher. And that even if we bought it at the peak here, where it went down after we bought it, it also came back up. So when you're down, and all of us are down now, it's not a permanent situation. I just showed you a chart in the S&P. Could it be permanent with one company like Humble? Sure, it could be. But Then we look at what else is going on. We're in a major trend in history with this cryptocurrency, with blockchain technology. We know that. That's a fact. We know that we have developed, Humble has, the tickets, the NFTs. They've done the mergers. They've got Monster Studios. They got Tickery. We got Brian down there in Santiago, Chile, working down there. We got the deal with Aria and that group. They got other deals they're working on. This is all factual. We got George Sharp helping the company get uplisted within the OTC and then probably onto the NASDAQ. I think it'll be at least a year on the NASDAQ, folks. I'm not saying that's short run. I'm just saying that you have to look sometimes at what's going on in the company. And the other thing that I meant to say is, as you also know factually, is that right now we are at about the year mark. I think we just passed technically year mark. My year anniversary for buying my first shares of Humble was December 8th. So that's coming up just in about a week, a little over a week. It'll be 1 year. The company didn't basically even exist except almost on paper a year ago, and now look at what it has achieved in the first year. This was a startup. You know that. So for all these bashers who want to act like the company's not going anywhere, look at where it is today versus where it started a year ago. Look at what it has developed in terms of actual revenue producing ticket sales, NFTs, and the rest. You know it. You know what I'm talking about. We've got other things that are going to be developed. We're going to be uplisted on the OTC. Eventually, we'll get to the the NASDAQ. We're going to have tokenization of real estate. This is a multi-year story, and you know we're closing out the third quarter of the first year in operation today. Today's the end of the third quarter, and then we go into the. Actually, I'm wrong. October was the end of the third quarter. So we're ending in November. This is the first month of the fourth quarter. Sorry, folks. I've been babbling a little. The fourth quarter is October, November, December. So today we're going to be closing out the second. I know what I'm trying to say. I'm just not saying it. I feel like Joe Biden here. We're closing out the second month of the fourth quarter, okay, in the first year of operation. So we're going to have December. And so the fourth quarter that we are currently in, we're 2/3 of the way through the fourth quarter, we'll get the earnings and the revenues for that quarter we are currently in around Valentine's Day. And that will be the very first time when we can look at 3 months of operations where we had tickets, where we had NFTs. And, you know, we got the EXTs, which were already out there. And we will see how things are progressing. And then we can start to think in terms of, is the company performing the way we want it to? That won't be the end of the story. We may be surprised in the good side. We may be surprised on the downside. But, folks, what I can tell you is what you already know. This is, you know, a 3 to 5 year hold in my estimation. The last thing I would say is, to those who think this is pump and dump, I'm not telling you to buy the stock. I'm not telling you to buy any stock. I'm trying to report why I think certain assets are worth buying today for the future value. I think INMD is one of those. It's down. A friend of mine was saying, well, the chart says it'll break the resistance line and go down. Well, today it did go down, but I don't think because it broke the resistance line. It went down because same reason the entire market was down, brought the INMD down. But as I said to him, where are you going to be in 5 years? That's what you want to be looking at. You don't go into the stock market, as I said earlier, like it's a horse race or like it's a slot machine. You're not going to get a payoff in the short run. And if you did cash in your chips in the short run, you're going to get a short profit if you have a profit, because the big profit is down the road. You want that. It's like this is easy, folks. It's like making snowmen. If you stop rolling your snowball, after 10 feet, you're not going to have a big ball. The big ball comes when you're able to roll over these profits over and over again. All right. I'm sure I probably got one person left listening, so I apologize for going so long. I would say, folks, that thanks for watching as always. Thanks for your comments, which I will try to respond to as best I can. I sometimes am responding to people also in the emails where it's just one-on-one because they're asking some specific question about their own portfolio. In any event, folks, if you don't want to be in Humble, then don't be in Humble. That's your decision, not mine. I'm not telling you to be in. I'm not telling you to be out. I'm trying to tell you why I think the stocks I talk about might be worth investing in. And as I've mentioned some other things, I've sometimes said, I'm not necessarily pounding the table on this. I just wanted to tell you to buy it. Remember, as I said tonight, and I'll say it again in closing, if you buy the SQQQ, do not put a whole bunch of money in there, and you typically only want to buy that as an insurance policy. So, ideally, you're going to, whatever money you put in there, you're going to kiss goodbye. So that's how I would use it. I was shorting the market back in summer of 2008. I made money in August. I closed out my short position, and of course in September the market fell over a cliff. I would have made a lot more money, but I didn't anticipate the market falling 40%. I did think that we were going to be going down. That's how you can make money when the market goes down, is with the SQQQ. There's a chart on the S&P 500 you could look up. I don't have the call letter on that if you wish. But you're not going to want to hold those shorts long term as you would more the TQQQ and the U Pro. Okay, all right, folks. Thanks for watching, and I will try to get back to you as often as I can the rest of this week, and we will see you. Hope you had a good Thanksgiving. Hope you have a good December and Christmas season, and we'll see you later.